Welcome to day 3 of the 5 of our 40th annual Eide Bailly Bank Seminar. At this time, I would like to recognize our partners and associates of Eide Bailly who support this event. Thank you for all your service you provide to our firm and also to our clients. My name is Gary Smith, and I'm the partner in charge of our Financial Institutions Services Group. Our motto for this year is Uncharted, leading the way to the next normal. And we're very excited to have our distinguished speakers join us today. John Kinsella is a CPA and Vice President with the American Bankers Association. John is joining us today to discuss current tax policy and prepare us for potential changes in tax policy. We'll also hear from our own tax partners at Eide Bailly, Jim Donovan and Jason Ulrich, about tax credits that can benefit your bank and your business customers. And we're also looking forward to hearing from the staff members of the Financial Accounting Standards Board's experts on CECL, Jay Shea and Amin Mohammed. Before we get to our program, I would like to thank Cheryl Knudsen and Amy DeGeorge, who spent considerable amount of time planning and organizing this event. To view the schedule for today, you should have received an email yesterday with a link to all the speaker bios, the presentations, everything from today. Or if you have questions, you can go to eidebailly.com/FI and we can help you and give you some assistance. I'm pleased to introduce to you one of our partners at Eide Bailly, Paul Sirik. Paul is the tax director of our firm's Financial Institutions Services practice and is a frequent presenter on bank tax topics, assisting our tax service providers in serving community bank clients just like you. Now I'd like to turn it over to Paul to introduce our first presenter.
Thanks a lot, Gary, and thanks everybody for attending today. We appreciate you being part of our virtual bank seminar. We've got 3 outstanding speakers here for our first hour for the bank tax update portion of today's session. John Kinsella, as Gary mentioned, will give us kind of an update on current issues in bank taxation, a view from Washington and the ABA. Then we'll follow with Jim Donovan and Jason Ulrich, both partners in our tax group in our firm that specialize in assisting our clients in analyzing and obtaining tax credits. First, I'll introduce John. John has been with the ABA, the American Bankers Association, as the VP and Director of Tax since 2015. John joined the ABA from US Bank Corp, where he was the Senior Vice President and Director of Taxation. John has more than 3 decades of experience in financial institutions tax issues and previously served as Chairman of the ABA's Tax Administrative Committee. In his role with the ABA, John provides technical expertise on tax legislation and advocates for member banks in the areas of federal and state and corporate taxation, international bank taxation, tax procedures and process, and various other components. So we have a lot of great info to get through, so I'm gonna turn it over to John and Jim and Jason.
Thanks, Paul, and thank you, Gary, and good afternoon, everyone. We really appreciate the opportunity to join you today, wherever you're at. Lots going on, so in about the next 20 minutes or so, probably going to go through things in a couple buckets. The first bucket is kind of the legislative environment, including a little discussion about some potential tax proposals that we may want to be thinking about as bankers. And then we went through kind of a potpourri of issues that you either might be dealing with or we want to make sure that you're aware of. So we're going to click through this stuff. Would very much appreciate any questions or comments. From the ABA's perspective, what we hear from our members is the best thing. And any feedback as to what you're seeing in the field is very important. So let's start out with legislative things. As we were preparing for the call here, as of Tuesday afternoon, before Tuesday afternoon, I think we were all thinking there was going to likely be an agreement between the House and the administration to have another COVID bill. And you likely read, saw, or whatever, that the president pulled his team away from negotiations on Tuesday afternoon. And while he backed off a bit overnight on Tuesday and into yesterday, at this point, it seems pretty unlikely that there will be another significant COVID bill that would occur prior to the election. So although it's not tax related, one of the key things that ABA was focused on in the legislation, the big legislation, and then also separate legislation, which I'm sure many of you are very focused on, was trying to introduce forgiveness simplification in the process for PPP loans. And it's very disappointing that that, at least at this point, hasn't happened. So in talking with my colleague this morning about the prospects, he pointed out a couple of things that, you never know, although he's very pessimistic prior to the election. B, he indicated that the SBA has been making noise about potentially having kind of some new forms or process that they may be announcing either later today or tomorrow that may provide some relief. I saw one account that would be perhaps applicable for loans up to $50,000, but who knows. And then finally, he asked, they just passed on that there was a new FAQ that was put into on SBA today, dealing with how you treat the modification period, the forbearance period for payments. It's the Q&A number 52, and I'll let you look at that at your convenience. When we were looking at the bill and thinking of, at least on the tax side, just point out a few things, even though at this point it's less relevant. In the Skinny Heroes bill, which is the House bill that was actually passed last week, that I think many people were using as kind of a template to see what sort of detail might be there, included deductibility of state and local tax, at least for 2020, kind of temporary relief on that. The fix of the PPP expense deduction issue that we're going to talk about here in a little bit more detail in a moment. Scale backs on NOLs, and then employee retention credit expansion, which I think Jim's going to talk about in much more detail in a few minutes. So it's uncertain what's going to happen with that. Those are the things that were on the table, at least in the House bill, and we'll have to kind of continue to monitor that. But those are, there's obviously all sorts of other things about individual provisions and employee, checks, separate checks set out, unemployment benefits, and so on, that were also under consideration in that bill. Kind of looking ahead after the election into kind of the lame duck session, there are a variety of things that who knows what's going to happen, but there are tax extenders that are outstanding for our industry, new markets tax credits, mortgage insurance premium deductions, a few other things. Interestingly, there's an important funding date for the government that expires as of 12/11. There's a continuing resolution that allows the government to be funded through that date. And many times that's an opportunity to have various things attached to get through as part of a bigger deal. So we will see. As well, you all read the news, it's a dynamic situation. We'll just leave it at that. Looking ahead, I want to just spend a few minutes, again, same sort of thing. You've probably seen many of these things. First of all, from a tax policy perspective, it's pretty apparent that there will not be significant tax policy changes unless the Democrats kind of do they call it a blue sweep, meaning Biden is elected president and the Senate flips to the Democrats as well, and they retain the House, which is similar to what President Trump had early in his term. And so just kind of clicking through a few of these things. And Amy, can I trouble you to go back one more time? Sorry, I'm probably giving you false signals here. And I'm not going to read it in detail, but I think for many of our members that at least are C corporations, the potential for a corporate tax rate is significant, and it raises a lot of money, as the note says. For S corporation banks, an increase of the individual rate back up to 39.6 would be important. There's a phase out of the 199A deduction for those shareholders that have over $400,000 of income. Kind of a sleeper for that some of our members have been focused on is there in Biden's plan, there's a provision that says that once you get over $400,000 in income, both the employer and the employee portion of Social Security taxes, so between the two of them, that's over 12%, kind of kick back in. Right now, you likely know that you get to around, I think, $137,000, you kind of cap out or max out on having Social Security taxes taken from your pay. You go north of that, between to over 400,000 in his proposal, you're back paying that, and it raises a ton of money. And some of our bigger members have done some modeling there, and it's a significant thing. Just the rest there doesn't apply probably to a lot of folks on this call, but the potential for a bank tax again, similar to what Obama proposed a number of years ago, and a minimum tax and increased GILTI. So anyway, it's safe to say that if there is a sweep, there's probably a lot of tax risk that we should be thinking about and potentially in our overall risk profile. A couple other things that aren't necessarily on Biden's proposals, but lots of talk about financial transaction tax. There's a lot of talk about that in Europe. There have been legislative proposals here in the States, and concern about how that would generate revenue to deal with our significant deficits that are coming out of the COVID crisis, and so on, wealth tax. So anyway, lots of proposals floating around, and we'll see what happens. So now we'll go to, I guess, what I would call the second bucket. Worked with Paul and kind of walked through a list of things that we thought that might be of interest or relevant to you. I'm just going to click through these quick. First of all, on PPP programs, I think many of our members have been trying to figure out how they should record for tax purposes the PPP fees that they earn from the SBA. When the program first started, I think people sort of thought, well, the forgiveness will happen in 2020, so there's not going to be really any big deal. I earned it, I get paid, and so on in 2020. Well, as you know, as things have turned out, it's likely that a lot of the forgiveness will actually happen in 2021. So you likely know that for book purposes, generally speaking, that fee is amortized over the life of the loan and as an adjustment to the yield. For tax, we have people that are going in two different directions and are evaluating what they want to do, treat it as kind of a service fee and recognize it all in 2020. Others are essentially following book treatment. That's our gut is that probably a lot of our members are indeed doing that. But there's a variety of reasons why you might consider taking different positions. You might think that, well, if I'm going to recognize income, I should do it in 2020. Everything's going to go to heck in 2021 with higher tax rates, and I should recognize that now, and so on. So there's, I think, still some uncertainty and different practices. The next item is it's been a hot topic. Notice 2020-32, by statute, the forgiveness of the loans from the SBA is a non-taxable event to the borrowers. Very straightforward. The IRS, however, came out with a notice that basically says that, yeah, fine, but if you, as you incurred your qualified expenses that entitle you to the forgiveness, because the income is non-taxable, you can't deduct that interest, those expenses. And so when we think about our borrowers that we're dealing with, it's a big deal. I mean, from the perspective that whatever, 1/3 or whatever your marginal tax rate is on your expenses, that decreases the benefit of the forgiveness. It really kind of obviates congressional intent. So a couple of things. First of all, there was legislation that was pending, including in some of the legislation we spoke about a few minutes ago, to correct that. But then people are now starting to figure this out, and we're hearing from our members that some advisors and borrowers are really trying to think through, well, what does that mean as to when I have to recognize that non-deductibility? Is it in 2020 because that's when I'm incurring the expense, or is it in 2021? Do I want to wait till 2021 because I'm deferring the tax, or do I want to make sure I recognize it in 2020? And so we talked to our members and then various accounting firms, and this is still an evolving issue, but it may be that as you're working with your borrowers, you're getting people that are kind of dragging their feet that say, well, I'm just going to wait as long as possible to file my application for forgiveness. And obviously that isn't good for us, banks, recognizing our income. So that's something you should just know that's out there. Next item was, of all this stuff, there was a little bit of good news. The IRS announced a couple of weeks ago now that banks will not have to file Form 1099-C, which is a form that records when there is a forgiveness of indebtedness in connection with PPP loans. So we, ABA, and other organizations lobbied the IRS and Treasury in that we felt that filing those forms would cause confusion for banks, borrowers, and it just would not be good. And to their credit, the IRS and Treasury, I think, appreciated that. The one minor rub is that we've heard some rumblings that maybe the SBA is going to issue them, and it's confusing why they would do that. But again, stay tuned on that. Forbearance we're going to talk about in a minute. Just a couple of real quick things that was in the CARES Act. There was a glitch in the tax reform bill with respect to qualified improvement property. It's like tenant improvements, whereby the depreciable life, just with the mechanics of how the bill was drafted, was extended instead of being 15 years and went to 39 years, which was very unattractive. And also because it was 39-year property, it wouldn't qualify for 100% expensing. And so the CARES Act fixed that relative to 2018. So if you have that circumstance, you might want to work with your advisors internally and with your advisors to determine how you want to make sure you understand what your number is and capture that, in that that's a pretty significant switch in when you'll be able to recover those costs. Net operating losses, the CARES Act had favorable provisions for individuals. Just real quickly, first of all, 5-year carrybacks for both individuals and corporations. Individuals, and that would include people that were owners from staff people, stock owners of pass-throughs. They would also be able to qualify for the 5-year carryback. And then for C corporations, same thing, 5 years. Obviously, if you're in the unfortunate, I guess, position of having an NOL carryback opportunity, theoretically, you could have the NOL go back into a pre-21% tax year and have some rate arbitrage, and potentially the same on the individual side, depending on your circumstance. Payroll tax deferrals, there was an opportunity for employers to defer the employer portion of the payroll taxes for 2020 and basically pay it back for 21 and 22. I think for at least some of our members, because money was so cheap and I guess in strong supply as banks, probably they had some sort of limited people that took advantage of it. Maybe you did, and it's all good. Keep it in the bank, so to speak. Anyway, that was the program. There was a relaxation on some limitations with respect to business interest expense, which applies to our customers. Banks, this is not applicable, an applicable provision, but basically allows a 50% limitation instead of a 30% limitation that has been helpful. And Jim's going to talk about the employee retention credit. I'm not going to spend much time here, particularly in light of we have a lot to cover here today. But I think we'd all agree that we're probably heading towards or in a period of time where there are economic strains, and we're going to be working with our customers for various types of modifications, whether it be forbearances for payment relief, or thinking through a restructuring, a modification of a loan. On the book side of things, as you know, with TDRs and other provisions in determining when you have impairment and charge-offs and so on, There's a whole regimen with respect to that. We were just, in connection with this slide, we wanted to point out that there's also a separate regimen for tax purposes. And there are rules about when you have a significant modification and how that might impact the debt obligation that you have, excuse me. And I think the thing to point out is that in certain circumstances, it may be beneficial for a taxpayer to take a close look at their loan portfolio and whether or not, for tax only and following the rules under section 1001, whether or not there's a modification, and the implications of a modification is there's a deemed sale or exchange. So it's loan by loan. I think pragmatically, many banks follow the book treatment as to whether or not there's a charge off and how it's being treated for non-accrual and so on. But in certain circumstances, it can make some sense looking carefully at that. On the mortgage side, you're probably aware that the CARES Act put in forbearance programs, and many of our members are sorting out what it means to have a 6-month deferral of payments and have that added to the end. The calculations are fairly complex. You can have a tax modification, you might not, and then there are varying implications for doing that. So I think we'll just stop on that. These are just 2 or 3 kind of things that we thought we'd just spend a minute on. The first, the payroll tax deferral was different than the thing in the CARES Act. So on August 8th, President Trump had a directive that went out that said that the employee portion of payroll taxes could be deferred for the balance of the year, and then they would be recovered next year. And so there was a directive that came out on August 8th. There was a notice as to, unfortunately, it's like a 3-page notice about how you implement that came out at the end of August for potential implementation by September 1st. We did a survey, just a very random, non-scientific survey of our members, and we found that there were, actually in our survey, there was no one that was actually planning on doing it. There were still some that were thinking about it, and just reading in the press and so on, I think most have decided it's not necessarily good for the employee because it's a deferral, not a forgiveness, at least assuming that it's not forgiven by Congress. And then also what concerns about what happens with people leave and how you recover that. So anyway, maybe well-intentioned by the president, but I think there were a lot of implementation and liability issues that were hard to overcome by employers. LIBOR transition, depending on what reference rate you use in your contracts or have used in your contracts, many of our members have big projects going to identify which of their loan and other existing loans and other documentation to make sure that they're identifying those situations where the elimination of LIBOR is going to cause issues. And from a tax perspective, the IRS has actually been fairly helpful, similar to how FASB has been with respect to providing relief in situations where there's a change in the contract due to a LIBOR transition issue. And there are proposed regulations out, and there are continuing discussions about that. Just last thing I'll just touch on, to the extent that you're dealing with the IRS, thankfully, I think many of our banks, particularly smaller ones, aren't bugged, if you will, that much by the IRS and don't have a lot of correspondence other than potential kind of routine things with penalty notices on TINs or payroll matters. We, meaning ABA, we participate in monthly calls with the IRS in Washington, and let's just say that they're struggling just like many of us are with respect to trying to get their operations up and running. And they ask for patience. And I suspect that if you have something that's kind of festering and you've acted in reasonable basis to try and correct it or answer the IRS or whatever it is, that would be, it'll be treated as being quote unquote okay. So anyway, so I'm just going to stop there real quick. Thank you again for allowing me to participate. And I don't know if there's any immediate questions or if we just want to do them at the end of this section. So Paul, I'll go back to you, or?
Yeah, thanks, John. I think at this time, our Q&A queue is clear. So thank you very much, John, for taking the time to spend with us here today. And we'll move on in our tax session to our next presenter, Jim Donovan, partner in our firm's National Tax Office, to tell us about the Employee Retention Credit and available R&D credits for banks.
Thank you, Paul. I appreciate it. As Paul mentioned, I am a partner at Eide Bailey in the National Tax Office, and I'm excited to speak to you guys today. I appreciate the opportunity to dress up. Work from home wear has gotten somewhat casual these days, so good to have a tie on again. As he mentioned, today I'm going to talk about the Employee Retention Credit as well as the R&D tax credit and its applicability to the banking industry. And with that, we'll start with the Employee Retention Credit and some basics here. So, you know, in terms of the Employee Retention Credit, this came out with the CARES Act in March, and it is a refundable credit up to $5,000 per eligible employee. And I know a lot of ears perked up, right? $5,000 per eligible employee, and I have a lot of employees, and it's refundable. So the numbers add up pretty quick, right? And just a quick note on how the credit's computed. It's a 50% credit rate, and that is based on wages that are paid to that employee during the eligibility period. So for example, if you qualify for the whole second quarter, you look at the wages paid to that employee during that time period, again, maxing out at 10K. And you can also look at applicable healthcare costs. These are healthcare costs that are not taxable to the employee, so they're personal contributions, employer contributions, as well as the bank's cost to administer the health plan. That can be allocated on a pro rata basis. So it makes it a little easier to get to that $10,000 per employee. Now you're saying, gosh, Jim, this all sounds great. How do I qualify to be an eligible employer and take advantage of the credit, right? Well, the the statute kind of gives us two prongs. It says, hey, if you're a trade or business that is fully or partially suspended due to orders from a government authority that limits commerce, travel, or group meetings for commercial, social, religious, or other purposes, you can qualify that way. Or the second prong is, you know, the bright line test, if you will, is a significant decline in gross receipts, and that's defined as greater than 50% over the same quarter last year. So, you know, you would compare second quarter 2020 compared to second quarter 2019, and if you had that decline, you qualify for the whole quarter. You know, and you're saying, well, gosh, Jim, banks certainly aren't going to meet that, and you're absolutely right. Every single bank I've talked to, there's no way they're going to meet that gross receipts test, right? So that puts us back at the first prong, and you say, well, there's a hiccup there because I've been defined as an essential business. I have to stay open, right? And so, you know, what I'll leave you with is a little teaser here that there's still a path forward for you to claim the ERC. And we'll get to that on the next slide, but I do want to hit a couple more basics before we move into that. And so, you know, in terms of taking the ERC, there is a difference right now if you are greater than 100 employees or have 100 employees or less. If you fall in that greater than bucket, you can only claim the ERC for employees that are being paid but not providing services. And so, for example, that would be a teller, right? And you're still paying them full time, but they're only working 50% of their normal hours. In that case, we could pick up 50% of their wages for the credit. And you know, conversely, if you fall in the bucket where, gosh, we have 100 or less employees, you get to take the ERC on everybody, regardless of, you know, whether their job's impacted or not by COVID-19. And the rule is based on the ACA law, so it's really looking at effectively 30 hours as a full-time employee, and that's based on 2019 average full-time employees. So that's what you need to know there. In terms of claiming the credit, you know, what I've seen is most of my clients are taking it on the 941, which is their quarterly payroll tax filing. You can also file a Form 7200 for immediate refund, or you can actually withhold or not make payment to the government of payroll taxes, and then you fill out the reconciliation form in the 941. again, what I'm seeing most of the time is people are just filing for the credit on the 941. They're not in a position where they need the cash right away. The last comment I'll make on this slide before we get into the how you qualify is that, hey, if you're taking a PPP loan right now, you can't double dip. You can't take ERC and PPP. So let's talk about how banks can take advantage of the ERC. And really, it involves a discussion of current events. First of all, we were looking at a possible expansion of ERC. We had the HEALS bill in the Senate, we had the HEROES bill in the House, and both of them had ERC expansion provisions. The HEROES bill was significantly better, and I don't have time to walk through all of the differences between the three, but suffice it to say that there was different thresholds with respect to the drop in gross receipts, the actual credit rate. That 100 employee threshold was raised in both of them. So it would have been all around a better deal if you qualify for the credit under either of those items. But as John mentioned, who knows what Congress is going to do and what will actually get hammered out in the end. So at that point, we have to look at, gosh, what guidance do we have in place? And so under the current law, banks can qualify. But as we trace through the law, you're like, gosh, well, we meet that first prong, right? We're fully or partially suspended. But again, we're an essential business. So while we felt the impacts of COVID-19, we were required to remain open. Well, the initial guidance from the Joint Committee on Taxation really didn't address this issue. They had some very vanilla examples about restaurants being, the dining room's closed, we can still do takeout. Are you suspended? Yeah. Okay. But then we got the frequently asked questions from the IRS. And again, even they kind of passed over this kind of scenario initially. And there were other examples of things they flip-flopped on, like furloughed employees, can they qualify or not? But really, we finally received some on-point discussion or questions and answers around essential businesses. More than just, hey, a manufacturer is an essential business, but they can't get supplies. So yeah, they're impacted. And really what we've seen here is there is a path to qualification, but it revolves around, gosh, did you have a government order in place? And some jurisdictions have been more open than others. I live in Iowa, and the governor's trying to keep everything open that they can. In California, things have been more restrictive, right? So, one, is there a government order in place? If you're closing your lobby or reducing your hours voluntarily, you're not going to qualify for the ERC. And then the second prong is really, was more than a nominal portion of the business fully or partially suspended? And so this is where we get into the individual fact pattern at the banks. And, do you have support to really say, hey, yeah, we felt the impact of COVID-19. I was on the phone with a bank client yesterday, and, their loans fell through the floor, just nothing happening. So, they have a really good fact pattern to claim the ERC because, a nominal, more than a nominal portion of their activities were really suspended with the closure of their lobby. And then you factor in that, so many activities happen in the lobby, right? Whether it's wealth planning or the loan services or just other critical activities, the lobby is kind of the hub of the bank. So again, if you have the numbers to support, gosh, we really lost out on a lot of business. Again, there's a path forward to claim the ERC. The one thing I guess I will mention on this is it does depend on the government order as far as the timing. So the eligibility period, really starts at when the government order starts and when the government order lifts. So for example, if it started on March 17th, I guess, and lifts on April 30th, that's the period we can claim the ERC. If you kept the bank lobby closed until May 15th, unfortunately, we still can't claim the ERC on those last 15 days. But again, it's a better answer than not being able to take advantage of the credit at all. So, that's the path forward. In terms of what we've learned with the ERC, I will say that, there's been some early adopters there, and those are the bright line, your restaurants, your retailers, right? We have a number of folks that are sitting on the fence saying, Well, they're looking at what happened with the PPP loans. There was some public shaming on some companies that took advantage of it, and they're like, man, I don't want to be called out like that. And maybe we're not in a financial or a position financially where we need it, so they're sitting on the fence. And I'd say the banking industry has largely been in the wait and see bucket. Hey, is there going to be an expansion? Is it going to be easier to qualify? And really, how's the IRS viewing this? And so that's really where we've shaken out. And like I said, it really depends on each bank's individual fact pattern. So that's what we have on the ERC. I'm going to talk briefly about R&D tax incentives here. So the R&D tax credit's been around for a lot longer than the ERC. Will be around for a lot longer afterwards. And for banks, let's be honest, the qualifying activity here is software development. And so if you have software development, and we'll walk through the kind of the fact pattern on the next slide, you could be looking at the R&D tax credit as a way to save money or put cash in your pocket, right? And that benefit range is really 5 to 8 cents on the dollar. So for every dollar of qualified expense we find, you're looking at 5 to 8 cents. And again, it's a convoluted calculation. That's why we have to give you a range. There are state credits available as well. Some of those state credits can exceed the federal benefit, and probably not applicable in this case. But if you're a startup company, you can offset payroll taxes with the R&D tax credit if you're pre-revenue, because it's a non-refundable credit. You're not limited to just the current year for looking at the R&D tax credit. You can look at all open years, typically the current year and the prior 3, and you have to amend those tax returns to claim the credit. And if you were in a position where you couldn't utilize it right away, it does carry forward for federal purposes for 20 years, and most states are 15 to 20 years. It does vary by jurisdiction. So again, a lot of opportunity to use it. Now you're saying, okay, Jim, well, it sounds great, but how do I qualify for this? And really what we're looking for banks is, where's the software development? Now there's some company or firms out there that are pitching the R&D tax credit saying, oh, you just take the entire IT group, right? It's all qualified. And having sat through enough IRS meetings around software development, I can tell you that's not the right way to go. It doesn't meet the letter of the law. Really, you're looking at, kind of 2 buckets here: in-house development and outsourced development. With respect to that in-house, you have IT, more than IT. You actually have developers, engineers who are writing something that's either going to be customer or vendor facing, or something in the back office, right? And so, again, it's generally a larger project. And you may choose to outsource it. And so with outsourced development, you can also qualify this, but there's a couple of sticking points. One, you have to be at risk for the development. So ideally, you're paying them on a time and materials basis, or it's not contingent upon them being successful. If you can say, hey, I'm not paying you if it's not successful, you can't pull it in for your credit. The second part is they can't have exclusive rights to what they develop. So that's something to watch out for if you outsource it. In terms of customer and vendor interaction versus back office, it's really the intention of the software. If it's developed for customer or vendor interaction, it's easier to qualify for the credit. If it's just for your sole purpose in the back office, there's additional tests, and it makes it a little harder to qualify for the R&D tax credit. So just some things to note there. If you think you may qualify, here's some common elements: software analysts, engineers, database developers. Any of those things below says, hey, maybe we're doing some R&D here, and we want to look into it a little further. So just 4 quick takeaways for you, and then I'll hand it over to Jason. So, number 1, to be determined if ERC expansion happens in Congress and what that means for banks, right? But, on the flip side, takeaway 2 is, hey, it's worth exploring. If you have a government order in place and you had to close your lobbies, there's a path to take advantage of the credit. Takeaway number 3, hey, if you have software development going on, you should at least inquire, hey, should I be looking at an R&D tax credit? Now, at 5 to 8 cents on the dollar, I will tell you, it generally takes a special project or a larger investment, A, to meet the criteria, and B, to make it worthwhile for you. So those are my thoughts, and I appreciate everyone's time today. And with that, I'm going to hand it over to Jason.
So I'm a tax partner in the Tulsa office, and I do a lot of work with various different kinds of investment tax credits. And so I'm excited to share a little bit of that with you today, because these can be very beneficial for financial institutions. One thing in the course of the quick introduction that I would share that's a distinction here is with the R&D tax credit that Jim had just mentioned. That is a credit for the use of the company that has actually incurred the qualifying cost. So if you had an S corporation, for example, that had an R&D credit, the S corp shareholders could utilize the credit against any income tax liability associated with that activity. The kinds of credits I'm going to discuss are a different type of credit, in the sense that these are formed by virtue of a policy that would allow us to utilize tax credit equity to help to subsidize the cost of projects that otherwise probably would never happen. And so what we've got here are partnership type structures where a developer will go out and undertake a project, and but for the tax credit and the ability to monetize that tax credit, they potentially would never proceed with that activity. And so the legislative intent here is to allow for private equity to come in and make a tax credit equity investment in the project, and for those credits to be allocated out to the members. So we're going to talk about the low-income housing tax credit, often called LIHTC, some new market tax credits, historic rehabilitation tax credits, and renewable solar energy. We'll talk just a bit about some planning considerations for these different credits, and briefly about the accounting for an investment in one of these structures. Low-income housing is something that's been around for a while. This is a credit that has the ability to offset AMT taxes for individuals. In the case of a S corporation, C corps of course don't have those anymore. These fall under the general limitation rules, where you have a 1-year carryback. They can be carried forward 20 years, individually kind of administered state by state through the different affordable housing authorities within the different states on behalf of the federal government. There are two types. There's a competitive program and a non-competitive program. And the states, many of the states will have piggyback affordable housing programs that fall under LIHTC as well. Those can also be either competitive or non-competitive. These projects can qualify for both historic and renewable credits as well. So you could envision a building that you do a historic rehabilitation on that's going to be low-income housing, or it might be some sort of mixed use potentially with a solar array on the roof. So you could potentially have more than one type of credit arising from one of these projects. These credits have a 15-year compliance period and a 15-year recapture period. So you become a partner in the project for 15 years, but the credits are accelerated. So the ability to claim the credits is accelerated over 10 years. And when you think about an investment in a low-income housing project, the primary return on your investment is going to be the tax credits that are allocated out annually and the deductions. You're generally going to get depreciation deductions, but there are risks. And so the risks here become real estate foreclosure, tax compliance, and asset management. And those two kind of go hand in hand. Part of what can trigger recapture is mismanaged property, where you charge above market rent for what you should have, or you allow non-qualified tenants in your low-income housing building. This particular type of a tax credit equity investment is primarily going to benefit banks from the standpoint of CRA investment. It is much safer to make an investment in a tax credit structure than it would be to make a whole bunch of low and moderate income loans. It has a lower rate of return as a consequence of that, but that is the primary emphasis for banks when they're looking at these particular projects. Next up is new markets. John had touched on the fact that this is part of the extender package. New market tax credits are slated to expire at the end of this year, 12/31/20. But these are designed to create some economic development in lower income and rural areas. These are credits that are, again, attractive. They have a 1-year carryback, 20-year carry forward. It is a competitive process where there's a certain amount of it to go around, and it's allocated to the different community development entities. And there's a couple of different ways they structure it. It's pretty common to raise tax credit equity and put that into an entity that makes a loan. When you look at these, the key to this is the but-for. This is because of the competitive nature of this. This is truly a situation where for the project to qualify, it absolutely has to prove beyond a shadow of a doubt that but for the tax credit equity coming into it and the structure moving forward, it would not be tenable to do. And by virtue of that, you're not going to see a hotel win a competitive allotment over a rural children's hospital, for example. These credits are claimed over 7 years. There's a 39% credit, and so what you have is 5% of that is claimed over the first 3 years, and then 6% for the latter 4 years. There's a 7-year recapture on that, and similar to the others, this has a couple of components to the return: the amount of tax credits that are claimed each year, and then the put proceeds. So there's a put that's exercised at the end to redeem the interest of the tax credit equity investor. And a big risk here is tax structuring of that, making sure that you do it properly. These two are a qualifying CRA investment. They don't have, they have a little higher yield. Typically, the return on investment is generally a little bit higher than the LIHTC credit would be. There are also some states that are doing this as a piggyback credit, but they're less common as well. There's been a more and more of an emphasis on these high distress areas where you're really focused on the low income areas and rural. That's really critical to the thing. But then the other aspect of this is there are a number of businesses that are prohibited from receiving benefits under this program. They call them the kind of the sin businesses. So historic rehabilitation tax credits are probably the most pervasive. This is a very popular credit. And really the idea is to identify buildings that are either on the National Register as a certified historic building or in a certified historic district. This is same thing. You have the AMT tax if you had an S corporation, where the credits would pass all the way through to the shareholders, could be claimed for both regular and AMT. These have the 1-year carry back, the 20-year carry forward. The thing that's attractive about this particular credit is it is administered by the National Park Service and the IRS in partnership with the different state housing preservation offices. And it's a 20% credit. So the qualified rehabilitation expenditures will be allowed a 20% credit. And there are a number of states that have what they call a piggyback credit as well, 32 of them, and it continues to grow. So you see more and more. California, it was one of the later additions to do this, and so it continues to grow. And usually the state credits are bifurcatable and or just outright transferable, where they can just sell them. So that's an attractive program. Polling question here: historic tax credits are subject to a 5-year recapture period. True or false? Give you a second to look at that one, and that one actually is kind of preempting my next slide, and the answer is they are subject to a 5-year recapture period. These are claimed ratably over 5 years unless they can somehow qualify under the transition rules. Prior to the Tax Cuts and Jobs Act, this was a 1-year credit that was claimed up front. As a consequence of the changes under the Tax Cuts and Jobs Act, they are now claimed ratably over 5 years. So your 20% credit you're going to get in 4% per year chunks to get it. But this can be attractive because we've now found ways to structure these where you can have a capital pay-in on the deal or spread out ratably over 5 years as well. So that can be good. The primary investment return components on these credits are the tax credits, the deductions, which would be the depreciation that's allocated out to the tax credit equity member. The priority returns, generally these have some sort of a 1 to 2% type of a return on capital from the original capital investment. And then there's put proceeds received at the end of the project. The primary investment risks on this are tax structuring. People used to get pretty exotic with this. We now have some safe harbor structures out there that are adhered to, so that's largely gone away. Real estate foreclosure can still be out there, but there's some things that can be done there to protect the project there. One of the things you'll notice on these is that they have a little bit higher rate of return after tax versus some of the earlier credits I've described. The other thing about the HTC credits here, the historic rehabilitation, is that you can have projects that will also qualify for CRA. So if you have a project that is going to be in an LMI community, or if it has the right tenant structure within it, it is possible. So that's something to consider when you're looking at a opportunity to potentially invest in a historic rehabilitation tax credit structure to benefit from the tax credits and the deductions. You could also have your cake and eat it too. So you might have a situation where you would have one that would be eligible for CRA as well. So that can be attractive. Renewable is the last credit I'll talk about, the solar credit. This is a credit that has been really, really popular because it's a 5-year asset. So when you have solar panels and solar arrays that are out there, these have a 5-year recovery period. And so whether bonus depreciation is taken or it's taken over a longer recovery period, it creates a pretty attractive deduction. Same thing, general limitation rule can apply to AMT for individuals, can carry back 1 year and forward 20. These are based originally on this 30% of the qualified investment, and it's begun to phase down. But there's a transition rule as well. So there was a safe harbor. So long as a tax credit project had incurred or paid 5% of the cost, there's a safe harbor where it would qualify for the 30% credit. So if that was paid or incurred before the end of 2019, that 30% rate could be preserved, even if that asset isn't placed in service for a year or two later. And so there's kind of this phase out that's going on. There was a residential credit that's going to drop off altogether. I left it in there, but the commercial and utility, which is really where you are going to garner the larger investment from tax credit equity investors, will eventually drop down to 10%. These are a 1-year credit, all claimed up front. They also have a 5-year recapture period as well. These have very attractive deductions that come through. The tax credits are attractive as well. A 30% credit is pretty strong. Priority returns each year in most projects, put proceeds at the end. Again, similar investment risk tax structuring, the operation of the project. You don't want to have the asset fall out of service. But what you'll notice here is this has the highest rate of return. So if the goal is to have the lowest possible taxes and to make the most impact on your tax liability, this is a great tax credit, but it does not qualify for CRA. So this is a pretty busy slide, kind of touched on this stuff really quickly. From tax planning standpoint, all of these are designed to pay the regular and the AMT tax for individuals. So in the case of an S-Corp shareholder, you can cover both of these. These, for a widely held C corporation, it covers any tax from any source. If you have a closely held C corp, you can have an exclusion for tax attributable to portfolio income, and that can be an impact for you. New market tax credits are designed to pay the tax on portfolio income. You can see my bullet point here about the ROI for the renewable energy credits are very substantial. A point here is the historic tax credit provides the lowest investment risk. And the other point that I want to make very briefly is the tax credit carrybacks. I talk about the general limitation rule where you can carry it back 1 year or carry it forward. There is a limitation under the passive activity rules. So individuals, if you don't have any other passive income, you wouldn't be able to utilize the credit. So it's important for an S-Corp that would consider doing one of these to have shareholders with other passive income, or have the shareholders be passive within the S-Corporation to benefit from this credit. And to the extent there isn't other passive tax or passive income, you may be limited in your carryback. And the reason that I say it's most beneficial for widely held C corporations is widely held C corps are not at risk taxpayers. And as a consequence, they could potentially have a much larger deduction come through in the case of, say, a solar credit project, which would allow more credit to be carried back if you had excess credit. So that's a mouthful, but that's kind of what we're trying to get to there. Here's a quick table to summarize the different credits side by side for reference. The credit period, the recapture period, the main risks, the primary return components, and then to kind of illustrate side by side what the varying rates of return are going to be on these, going from the single to the double digit. And that can be largely impacted by the pricing. So if you negotiate a different price or more attractive price that's more beneficial to you, you can certainly enhance the yield there. And then I'm going to close out really quickly with some accounting for the investment. So this comes up a lot. There's a couple ways to do the accounting. The deferral method, where the income tax credit is reflected in income over the productive life of the acquired property. The deferral of the income tax credit is reported either as a reduction in the carrying amount of the related asset, or in a separate deferral account is reflected in income tax expense over the productive life of the acquired property. Typically, the income tax credits are recognized in pre-tax income as a reduction of expense from increase in income. Or the flow-through method, the income taxes credit is treated as a reduction of federal income taxes immediately in the year in which the credit is generated. And then you can also have some timing differences, some temporary differences, which will arise when accounting for an income tax credit, and can be accounted for under two different methodologies. The gross up method, where the deferred tax related to the temporary difference would be recorded as an adjustment to the carrying value of the underlying asset, and then the income statement method where the deferred taxes relate to the temporary difference would be recorded in income tax provision expense. That was a mouthful. I ran through it really quickly. I'm a tax guy, not a GAAP guy. But the thing to note there is that these are method of accounting policy elections, and you have to be attentive to changes. And then the last thought here that commonly comes up is who should own the investment? Should the bank make the investment outright to benefit from it, or should the holding company make the investment? And what we see is that if it's an investment being made primarily to maximize tax savings, it's common for that to be made at the holding company level. If it's primarily based on the CRA, or if that's the emphasis, then the bank subsidiary will make the investment, and they'll need to seek the regulatory approval for that, which is pretty routine. So that's not a surprise to your regulators. One note on that is that there is a need to establish and document the internal controls that support the institution's objectives while making sure you've got the right accounting treatment, et cetera. And that was my speedy transition through all of that, and I would open it up for any questions if there are any.
All right. Thank you, Jason. We'll proceed into the accounting update for today. Thank you again to you and to the rest of you and John and Jim. So good job. All right, now we're going to move on to the accounting update, and specifically we're going to dust off our discussion on CECL. I know we've kind of brought that up and then kind of tabled it a little bit, but what better way to do that than to bring in some experts from the FASB today. So I'd like to introduce our speakers today. Jay Shea, he's supervising project manager for the FASB, and Amin Mohammed, he's the assistant project manager. So I'll turn it over to Jay and Amin.
Thanks, Gary. Thanks for the introduction. So we're glad to be here. It's been a while since we've been on our CECL workshop circuit. We haven't had a chance to do these workshops in a while with everything going on. So hopefully this is a sign for things are improving and getting better. So today's presentation will run about 45 minutes. So just looking at the clock from my end, it's 3:03. So we'll stop at 3:50 Eastern time to make sure we can take some questions at the end. The material that we have for everyone today will primarily just start with a high-level overview of the CECL standard, and then Amin will walk through the areas that are kind of core to the guidance, so the main areas that are most applicable to most financial institutions. And then if we have time, we'll walk through an example, the warm example at the end. So before I start with the high-level overview, there are a couple of things I did want to mention up front in the beginning while we have time. So I thought this would be helpful to kind of give everyone an overview on where we are, what the team is doing right now, and some of the immediate next steps. So right now we are monitoring the CECL rollout each quarter by reviewing the 10-Qs for a number of entities that have adopted CECL. We're watching and listening to earnings calls. We are analyzing the call reports for financial institutions each quarter. We're reaching out to banks of all sizes, adopters, non-adopters alike, to determine what worked well, what has not worked well with the standard for those who have adopted. For those entities who have not adopted, we're asking them questions on how their implementation process is going, where they are in that process, what are some of the next steps they'll have to incur to adopt the standard by 2023. We're also interested in talking to folks to see what kind of impact COVID-19 has had on your ability to adopt the standard. So if anyone is interested in kind of having those discussions with us, whether it's in a group session or a private session, please let me know. It is a little too early to talk about, to share really any conclusions on what we have heard and learned so far in 2020 as CECL is rolled out, but there is some feedback that we have received that I can share. Banks who adopted CECL in Q1 2020 felt like they were well prepared. All the work institutions did to put in at the beginning and for planning purposes really paid off. So think of all the work you did on the data, gathering your data, performing dry runs, testing and retesting systems to made adoption much easier for institutions. And although COVID wasn't expected at the end of Q1, banks were able to evaluate and rapidly change their reserving to the economic environment, and they made those changes in Q1 and Q2. Listening to earnings calls and having discussions with investors, as most of you can imagine, the questions that we received and the questions that we heard in Q1 were mostly focused on macroeconomic data. Most investors on the earnings calls were focused on key assumptions like unemployment rates, GDP. There were a lot of questions and discussions on those factors, where they were going, what were the assumptions that were being used by banks. In Q2, listening to earnings calls, what we heard was that there was a shift to asking questions on when banks would start realizing those losses that were expected in Q1. There is more information provided on macroeconomic data by some of the institutions, which helped answer the questions investors had from Q1. But we saw a shift to starting to ask questions on charge-offs. We have received some early feedback that investors find PCD accounting confusing and preparers find it challenging. So that's kind of just a general synopsis of what we've heard so far. We're pretty early in our process. The plan to do outreach will cover the next few months, and then we'll go into 2021, and hopefully we can get good feedback from institutions that have and those institutions that have not adopted CECL. So I'll just start with the background and then hand it back over to Amin to walk through some of the more core areas of the guidance. So at a high level, the basic principle of CECL hasn't changed. The standard was issued in 2016. There have been changes to the guidance subsequent to issuing the standard, but those changes were primarily clarifications and in certain situations or simplifications. At the end of the day, the reserve is just a valuation account that you either add or subtract to your financial asset to get it back to the net amount you expect to collect. And I just want to point out a very small nuance here, which is captured in this black box to the left. The word add, so adding your allowance to your financial asset sounds weird, but in certain situations, the board really wanted to make it clear that entities can include recoveries. So when you're measuring your allowance for credit losses, you can include an expectation of a recovery. Those recovery amounts are limited to amounts you previously have written off or expect to write off. But we just wanted to make sure that the guidance was clear on recoveries, as there was some language in the original draft that made it a little unclear whether or not those could be included when you do your allowance measurement on day one. Other than that, the principle hasn't changed. So Amin will kind of walk us through some of these components as we go through this presentation. This is probably not the best attempt, not the best looking slide, but it's our attempt to kind of highlight this is the path to CECL. Most of you are familiar with the first two balloons. Today you start off with your historical losses, and then you adjust those losses for your current conditions using Q factors. So it's either a plus or a minus, depending on what's going on in the current environment. The new component is this light blue balloon. It's your reasonable and supportable forecast, which has gotten most attention from folks. Of course, it's the new component you're adding to the allowance, so that makes sense. And then the last piece is the fourth piece here, this last red balloon, which we're essentially just trying to highlight here, is that you're reverting back to your historical losses. And we purposely tried to shade these so that they're the same color, the beginning historical losses and this final reversion portion. Because once you finish your reasonable and supportable forecast, you're really just reverting back to your historical loss assumptions. So whatever is the remaining term of your loan or your other financial asset, if it's a mortgage loan with a prepayment assumption, it gets you down to 7 years. And if you have a reasonable and supportable forecast of 1 year, you're effectively just reverting from your reasonable supportable back to your historical. And then you're just using the same data that you would normally be using from your historicals. So today, most of you should be familiar with this loss rate methodology. So we like to have this slide here, but just to highlight at a high level, just a very simple slide that kind of highlights the what it looks like from going from the incurred loss model to CECL. The biggest difference between the incurred loss model and CECL is that there is no more loss emergence period. So under CECL, you're recognizing a lot of your allowance for the life of the loan. You're no longer having to determine what are your expected losses for 1 year or 2 year, depending on what your loss emergence period is today. So what's changing and what's not changing? So today, asset classes are required different estimation methods. That'll be changing under the new standard. Pooling is permitted but not required, and then you recognize losses when probable. Those 3 bullets on the left are gone under CECL. So we won't have the probable threshold anymore, and the board eliminated many of the models or methodologies for different asset classes. So now we have a single impairment model. In the middle, these are the things that you're probably doing today that'll carry forward when you're adopting CECL in the future. So if today you're applying a very simple loss estimation methodology, you don't have to change that. So the guidance doesn't require you to switch to anything that's more complicated than what you were doing today. So for most institutions, if you're doing a loss rate, then you can continue doing a loss rate. If you're using something more sophisticated like a discounted cash flow, then yeah, you can continue doing a discounted cash flow under CECL. The board really wanted to emphasize that the guidance is scalable and flexible, and it's really more of a principle-based standard. So that's why there's no specific estimation methodology required. You will still consider your past and current conditions. As we noted in the slide before, it's the historical balloon and then the current Q factor adjustment like you do today. As with any estimate, the standard requires judgment. At the end of the day, CECL is just an estimate. The only thing we know for sure is that your allowance for credit losses will not be correct because it's an estimate. So the amount or the timing won't be right, but it's your best estimate. It's what the entity expects going forward. Under the new standard, like I mentioned earlier, we'll have a single impairment model. Pooling is required when assets have similar risk characteristics. For most financial institutions, this hasn't been a major issue or a question. Most of you are familiar with pooling, so it shouldn't be a big concern. Obviously, a reasonable and supportable forecast is the newest element to measuring your allowance. So we'll cover that in detail as we go through the presentation. And then the big change, no thresholds for recognizing losses. That means we eliminated the probable threshold. So as I mentioned earlier, the standard is intended to be scalable and flexible. And so what does that mean? It means that you'll have to apply judgment as you apply the standard. The guidance is intentionally principles-based. Banks and other companies will have to apply judgment when measuring the allowance, which is very important for everyone to remember. This isn't a standard that's going to tell you what to do in every instance. And you'll notice on the next slide, the board knew this when they issued the standard. They provided a full list of areas that is not all-inclusive, but just to give you some examples, they provided a list of all the areas where judgment will be required. I do think it's really important for everyone to remember that you do have to document your assumptions. So that's prevalent today. Back in my day of auditing, which was a long time ago, audit documentation, we required that the institutions told us how they came up with the reserves, what were their Q factor adjustments, why they're making those adjustments. They had to explain it, and then we had to document that. Your estimation method should be practical and relevant to your institution. You do not need to you don't need to copy what a larger institution is doing or your peer institution is doing. It's really what's relevant for your particular institution. Your methodology should be applied consistently. That's really important to remember. So, if you pick a technique, you should probably try to keep that technique over time. You shouldn't switch between techniques. On the next slide, we have a list of kind of areas where there's judgment involved. So I won't cover all of these, but I will point out at the top of the slide, in some of the slides going forward, you'll see this purple ribbon. These purple ribbons are meant to indicate where in the guidance you can find these particular references. So in 326.2055-6, there's a list of areas where the board had highlighted where judgments can be involved. So I won't cover on all of these, but I did want to mention a couple of them. So, the approach is going to require, for judgment to using historical periods. So what is the appropriate historical period when you're measuring your losses? Is it the last 10 years? Is it the last 5 years? Perhaps you want to skip the last few years and go back to 2008 to 2013. That may be more relevant for your financial institution depending on the makeup of your book. It really does depend on what you think is most relevant for your institution. So that's just one example. Prepayments is another example. Every institution has probably incurred a prepayment in some form, either a borrower refinancing a loan or paying down their loan early. That's what's meant by prepayment. It's not an involuntary prepayment, it's a voluntary prepayment.
Moving on, as Jay mentioned, I'm going to talk a little more about the different components of the allowance for credit losses under CECL. But before I do that, I'd like to address some of the questions that we receive whenever we do these workshops. So we've done 12 of these so far. We started doing the CECL workshops last year, and in every workshop we get similar questions. So before we delve into the details, let's just go ahead and address these questions. And as I go through the detailed components, I'll be coming back to these questions. So the first question first major question we get is, how do you address low loss history? So an institution probably just issued a new loan product type in the last few years, or they haven't been tracking the loss history so far. And what do you do with that? And our answer is one of two things. One, start tracking it. You still have time. The standard isn't effective for non-public entities until 2023. So you have some time until then to start tracking and hopefully build a loss history. But if you still think that you're short, another thing you could do is the standard doesn't require you to use internal sources. You could use external sources to get the loss history. And by external sources, I want to be careful whenever I say external sources. The FASB is in no way telling you to go buy data. There's a lot of data online that's free. You could look at peer group call reports. This is something a lot of institutions already do today. And that's another way to build loss history. There's a lot of information on the agency's website. So Fannie, Freddie, they put out loan level information on their securitization. So that's another tool you could use to get the loss history. So you could either use your internal loss history or external loss history, or say if it's a new product, which is the second, or I think the third question there, how do you address lack of historical data for de novo institutions or new products? If it's a new product, that's a business decision that you've made, and you probably have a sense of what the losses are going to be on a pool basis. Again, the standard doesn't require you to estimate lifetime losses on each individual loan. It requires you to estimate losses on a pool basis, and also it requires you to take into consideration prepayment. So you're not actually estimating losses on the life of the loans. You're taking into account how fast the pool will prepay, and then estimating losses on that remaining life. So that would be a good starting point, your internal estimate of what you expect losses to be on that pool. Again, peer group data is really helpful there, and there's some external information out there that could help you out. The standard is really reliant on historical data and data in general. So if you haven't really started looking at your data or started collecting data, I'd say start as soon as possible to make your life easier when you do get to the point to implementing the standard. The second question again is on addressing data gaps such as prepayments, renewals, maturities. We understand, one of the significant inputs to the allowance estimation process is prepayments. And as Jay mentioned, it's voluntary prepayments. It's not involuntary prepayments that you're trying to solve for. And we also understand that not all core systems track that information. So one place where you could get prepayment information would be from your ALM systems. You're already, either you or your ALM vendor are already incorporating prepayment assumptions into the ALM process. So that's the first place where you could get some information. And again, there's a lot of information out there, which is publicly available. I know SIFMA has some information, and this is going back some years, used to be available on their website. The Mortgage Bankers Association has some information. Again, the agencies have some information on their website. So there's quite a bit of information available online if you don't have it. But I'd say the best place would be your own internal data, because that's what you'll be using to forecast future losses. And so that would be the best starting point, was if you have your own, if you've been tracking prepayments on your pool of loans, that would be the best source. And then the next question is, how do you develop reasonable and supportable forecasts in community bank and correlate forecast metrics to existing bank data to ensure it's relevant? Want to point out here that there's nowhere in the standard that requires you to correlate any sort of losses to actual losses. Obviously, as Jay mentioned, as the whole process of estimating losses is judgmental and requires you to make tweaks to the process as you go along. So as you go along, if you see you're overestimating losses or underestimating losses, you tweak your process, but there's nowhere in the standard that requires you to do a mathematical regression or correlation analysis to estimate those losses. I'd say just, kind of the proof's going to be in the pudding. So your losses are going to shape up to be what you're forecasting it to be, or it's not going to be as you're forecasting it to be. So, it's look at your actuals and look at where you're forecasting every quarter, just as you do today. It's no different than what you do today. And then another popular question is, how does a community bank determine the appropriate methodology to use? Obviously, this varies from bank to bank. Again, there's nowhere in the standard where we tell you to go buy models or to use a complicated discounted cash flow methodology. We actually have 2 staff Q&As, FASB staff Q&As on our website, which I'll get to in a second. And one of those Q&As talks about the WARM method, which I'm assuming a lot of people are aware of, but if you're not, it's the weighted average remaining maturity method or remaining months method. And that's a simple loss rate method that most institutions can do on Excel. So there's that would be a good starting point. Now, again, the WARM method has some limitations. So the WARM method relies a lot on historical data and historical losses to predict future losses. And if you feel like historical losses is not a good indicator, or if you have a pool of loans that has losses that occur in lumps and not ratably over the a term of the pool, I'd say some other method is probably more useful. Not saying that you can't use the WARM method. It's just that you'd have to rely more on Q factors or your reasonable and supportable forecast in that. If you do use a WARM method. And then the last question is considerations when determining contractual lives. So there's we actually have a slide on this because we thought this was important. Again, the standard does not require you to forecast losses on the entire contractual life of the asset. the standard requires you to estimate prepayments when forecasting losses. And those prepayments can be a separate input to your model. So if you have been tracking prepayments loan by loan, you can use that as an input to your model, or you could apply prepayments in the loss rate that you're using. So you could use a prepayment adjusted loss rate to come up with your future losses. Also, you have to be careful about contractual extensions of loans. I know a lot of community bankers have commercial loans, which are rolling loans, so they mature after a certain period, but then are extended or underwritten again and then extended. You know, contractual expected extensions are not factored into the model, only the extension that you are contractually required to, or is binding, that's required to be factored into the model, unless you think that you expect a TDR, and those are required to be considered within the model. And another popular question we get is, what about credit card lives? How do I figure out the contractual life on a credit card? There again, the model is flexible, as Jay mentioned. I'd say the Card Act is a good place to start, where it tells you how to figure out which balance of the credit card will pay off first. And the guidance does not require you to consider future balances, but if you have the ability to consider future balances and how that will impact your future losses, then you're free to do so. We actually have extended write-up on forecasting losses on credit cards on our website. Our transition resource group, or TRG, talked about it in detail. So if you go to FASB.org and go to the CECL page, you can access all our TRG documents, and there's one specific document on forecasting lives on credit cards. All right, with this, we'll dive into the components a little bit. So where do you begin? As with any loss estimation process, you begin with your historical losses. Historical losses, as I said, you know, doesn't necessarily mean internal or your institution-specific historical losses. You could get those historical losses from external sources. You do have to consider adjustments to historical losses for asset-specific considerations. So say, you know, you're looking at the last 5 years of historical losses as a starting point, but baked into those historical losses is a loan product that you don't sell anymore. Well, you do have to adjust those historical losses for that loan product. And then, you know, again, another example that you see on the screen is changes in underwriting. So you historically had a tighter underwriting, but you made a strategic management decision to loosen up underwriting to, say, take advantage of the higher yields. And so you'd have to make some adjustments to your historical losses to incorporate that. And again, this is not different from what most of you are probably doing today. So the starting point, historical losses, is the same as it's been in the legacy guidance. There's 3 judgment drivers in historical losses that I'd like to point out. One is historical loss quality. Again, you know, that's your data quality. That's the most important. CECL model is kind of like garbage in, garbage out. So if you don't have good data, you're not going to get a good output. And historical losses in a lot of loss estimation models, including the WARM method, is the core of that model. So you have to really make sure that your historical loss data it looks good. And then the other judgment that you have to make, and you're probably doing this, is the length of look back period. So how far back do you look back? Again, the guidance, there's no specific guidance on this. It's you know, the guidance is flexible and scalable. So whatever you think it makes sense for estimating future losses, and you're probably doing this under legacy guidance today. You're probably looking back 5 years saying that, hey, the losses that I've experienced in the last 5 years is representative of the losses that I'm going to experience going forward, or you're going back a whole economic cycle and looking at kind of like a through the cycle approach. And again, that's a judgment driver. And as Jay mentioned, that has to be documented. And then storing actual results over time. As I said before, the guidance does not require you to correlate losses to what you're forecasting, but you do have to store your results over time and incorporate that when estimating future losses, but also look at your forecasting process and kind of make tweaks if future losses don't shape up the way that you expect it to. Next, we talk about qualitative adjustments. So similar to today, qualitative adjustments are permitted under CECL. There's 3 types of qualitative adjustments. You could have qualitative adjustments for past events. Say you are just coming out of an economic downturn and you're expecting to get better, but your historical losses represents losses when you were in the economic downturn. So that would be one qualitative adjustment. The other is a qualitative adjustment for current conditions or the Q factors. Right now we're going through a global pandemic. No one knows what's going to happen. But a lot of institutions are already factoring somewhat of a higher losses in their Q factors, and you would do so under CECL. The one thing that's new under CECL, and that we'll talk about in a couple of minutes here, is a reasonable and supportable forecast. So not only do you make adjustments, Q factor adjustments for the environment today, but you also make adjustments for what's going to happen tomorrow. I do want to stress that the information that you're looking for or the factors that you're adjusting for should be relevant to your ability to assess credit losses, and you do not have to forecast factors that are not relevant. So say if you're primarily an ag bank, one of the major factors that would be relevant to you would be commodity prices. But if you were a community bank that had clients in mostly commercial real estate or customers that have government contracts, commodity prices are probably not going to be a big driver of your losses. So the first step would be to figure out what's driving your losses, and then figure out, okay, how are those losses going to be impacted in the future? Where do you get this information? The guidance does not require you to do an exhaustive search to figure out, hey, this is all the inputs that I could find. It just requires you to find information that's sufficient and appropriate. So that information can be both internal or external information. Again, when I say external information, it's nowhere in the standard that tells you to go buy economic data or economic forecasts from an economist. If you're a community bank, national factors are probably not going to impact you that much. You have to make that determination yourself, and you probably have a better handle of what's going on in your community than most economists. And so just factor in that information. Again, qualitative adjustments can be quantitative or qualitative. So as I said before, there's nowhere in the guidance which tells you to run a sophisticated regression analysis to see how unemployment rates will impact your losses. You could start off with what you're doing for your Q factors today and kind of build on that process. But there's nowhere in the guidance that tells you to do a sophisticated mathematical analysis for this process. And then let's talk about reasonable and supportable forecasts. And before I get into this, I just want to remind people, I think Jay already talked about this, but the purple flags that you see up on the screen, that's all the guidance that we're referring to. So if you have any question, we at the FASB always like to point back to guidance. or if you want to verify that anything we're saying, that's the exact paragraphs in the guidance that we're referring to. And all the flags that we have in this presentation today is probably most relevant to community banks. So the guidance itself is about 200 pages. I have it here. But honestly, about 20 to 30 pages is probably the most relevant to community banks, and we've highlighted some of the most relevant pieces of the guidance. So it's always a good idea to go back and read the guidance so that what's actually required, and when you're talking to vendors or your auditors, you actually know what's required from the guidance, and it will help you make better decisions. Okay, let's jump into talking a little bit about reasonable and supportable forecasts. Again, as I said before, information can be internal, external, or it could be a combination of internal and external. And you're not required to perform an exhaustive search of all possible information, only reasonably available information. And in some cases, you might find internal information sufficient. And as we said before, you're not required to forecast. The guidance does not require you to forecast losses over the entire contractual term. You're only required to forecast over the reasonable term that say you're going through a period where you see losses increasing in the future, such as today, where there's a lot of forbearance programs and loan modification programs that have kind of abated loan losses, but you do know there's some losses coming in the pipeline, and you tweak your allowance for loan losses for the losses that are coming in the pipeline. That's different than the legacy or the guidance that you're using today, where you wait for losses to be probable. So you do wait for loans to become delinquent or go through the delinquency cycle and see losses ticking up to increase your reserves. So if you do see something down in the pipeline, you adjust your allowance for loan losses there. And you consider refining your future estimate based on your actual experience. We get this question a lot, and that's why I do want to point it out. Hey, I'm a community bank. Why should I use national unemployment rates to forecast losses? And then our answer is, why should you use national unemployment rate? It's not one, it's not required in the standard, and two, it doesn't make sense. If you are serving a community that's, say, the largest employer in that community is a factory, national unemployment rate's probably not going to impact that community that much. What's going on with the factory would probably impact the community. So say you hear that the factory is going out of business or thinking of moving to another state in a couple of years. And you do know, as a result of that, since this factory is such a large employer of so many people in the community, there's going to be job losses, and that's probably going to increase loan losses in your portfolio. That would be something that you would incorporate in your allowance for loan losses. And again, you don't have to incorporate. Nobody can forecast anything over 30 years for a mortgage, say. So you don't have to incorporate, 30 years of forecast, but anything you see in the next year, 2 years, you do incorporate that. And after that, you revert to your historical losses. And again, that's historical losses, something that you're doing today. So this shouldn't be a new process. What we are seeing with the public banks today is, they have a reasonable and supportable period of somewhere over 1 to 2 years. Nobody can see beyond a year or max 2 years on what's going on. So, a lot of publicly traded banks have actually shortened their historical lifetime, has shortened their reasonable and supportable forecast period to 1 to 2 years. So that's another thing that you have to consider is kind of look at your reasonable and supportable period and be ready to kind of increase that period if you do see losses coming down in the future, or shorten it and then revert back to your historical losses in periods of high uncertainty as today. Let's talk a little bit about reversion. You know, what should you do for periods beyond reasonable and supportable? And you revert to historical losses. How do you revert to historical losses? Again, there's no particular way for you to revert back to historical losses. The guidance is flexible. If you want to revert back immediately, you know, that's a judgment that you'll have to make. If you want to revert back on a straight line basis, that's another judgment you have to make. But again, the guidance is flexible there. The only thing the guidance specifies is you do not adjust your historical loss information when you're reverting back to historical losses. So the only time you adjust your information is when you're in your reasonable and supportable forecast period, or for qualitative adjustments, you revert back to historical losses, to your unadjusted historical losses. The only time you would really adjust historical losses if there was something in your historical losses that's not in your loan portfolio today. So again, as I said, if there was a loan product that you're offering before that's not in your loan portfolio today, you would adjust for that in your historical losses. All right, I know I have a couple minutes here, so I'll just briefly talk about the WARM method, and do want to remind everyone that we have an entire staff Q&A on this WARM method on our website, which goes through the math and has a detailed example and has all numbers. So please feel free to go to our website, and you know, if you have any questions, you know, please feel free to reach out to either Jay or I, and we'll be happy to help you if you do have any questions on either the WARM method or CECL in general. So what is the WARM method? It's the weighted average remaining months or remaining maturity method, and it uses annual charge-off rates. So the WARM method is very similar to today's loss rate method. It uses your average annual charge-off rate as a starting point. You then convert the average annual charge-off rate to a lifetime charge-off rate, because you're solving for lifetime losses, and there's a method on how you convert it. One of the methods is shown below in that screen, where you take your average annual charge-off rate times your amortization adjusted remaining life to come up with your lifetime charge-off rate. That's one of the methods. Again, you have to be careful of amortization adjusted remaining life. Say you have a pool of loans that are 30-year mortgages, but those mortgages amortize. You do have to factor that in. So it's probably not 30 years if you take your amortization adjusted remaining life. And then once you have the lifetime historical charge-off rate, you apply your Q factor and your reasonable and supportable assumption on top of the lifetime historical rate to come up with your loss rate that you would apply to the pool of assets that you're using WARM method on. And then the next slide talks about, you know, one of the very common questions is how do I know if I should use the WARM method? Again, you know, we, the FASB staff, believe the WARM method is relatively simple, can be created on a simple Excel spreadsheet, but it also depends on how complex your pool of assets are. So say you have you know, pretty homogeneous pool of assets with consistent runoff rates, you know, the WARM method is going to be an excellent method to determine your lifetime losses under CECL. However, if your losses are lumpy or sporadic and don't have predictive patterns, you know, the WARM method, not saying that the WARM method cannot be used, but you'd have to make significant Q factor adjustments, because your historical losses probably won't be a good predictor of what's down in the pipeline. And again, the WARM method, it goes without saying, the WARM method relies a lot on historical losses. So if your historical losses data is not the best, you know, the WARM method is not going to be the best method that would give you accurate results. You know, the starting point has to be really good. again, you could mitigate all that with Q factors, but you do have to document that and explain Q factors to your regulators and auditors, just as you do today.
So we had a couple of questions come in, guys. I wanted to pose to you. I know, Jay, you talked about the fact that you have a number of, you're monitoring the banks that have adopted CECL here in Q1 and Q2. Do you have any data points as to where CECL adoption is compared to those banks that are still under the incurred model? Is it larger, less, or is there any numbers like that?
Yeah, so we had a slide that we got a few slides back, but just to give you a quick answer, provisions or the allowance ratio for banks that adopted at the end of Q4 was about 1.25. And then by the end of Q1, for those same subset of banks, it was about just under 2. So it's about a 63% increase from Q4 to Q1. And then in Q2, we saw a 32% increase in that allowance ratio. So for those same banks, just call them SEC filers, we see the allowance ratio being above 2.5. So let's call it 2.55 or whatever. That's where we're seeing for the SEC filers. For non-SEC filers, excluding credit unions, we're seeing reserve ratios starting from using the same Q4 data, being a little bit above the SEC filers, so probably 1.3, getting closer to 1.5, and then at the end of Q2, being closer to like 1.6, 1.7. So that's what we're seeing in comparison between those two buckets. And then for credit unions, we're seeing the allowance ratios growing from 80 bips to about 1%, 100 bips over that same time period.
So it's definitely some COVID increases in the incurred model, but not near to the extent of like the CECL model. That's kind of the conclusion, right? Is that fair to say on some of that?
I think it's evenly split.
Okay.
So I think we saw an even split. So from the disclosures that a lot of the banks put forth at the end of, or in Q1, a lot of them did a roll forward to kind of capture, hey, this is our conversion to CECL, so transition to CECL, and then the COVID bump. So I think it was about evenly split. I don't want to be definitive on that, but it's all available. But at least that's what I've seen so far.
Okay, good. Maybe time for one more question. I know we've had a couple of questions come in. Obviously, to community banks, the regulators are significant to them, right? And having to work with the regulators. And I know you've done a lot of outreach with the regulators these last few years. And a number of the community banks are looking at models that potentially utilize call report data and codes for their calculation. Have you had any discussions about the adequacy of the granularity to meet the intent of 326 from the regulators utilizing call report, or do they have the expectation that it's going to be different than the call report?
What data they use?
Mm-hmm.
So for historical data, I mean, you can use your actuals, and that's going to come from call reports. It's going to come from whatever systems you have in place today. For your reasonable and supportable, if you're asking if you can use peer data, I think that's an input you can certainly use, right? So a lot of banks, some banks publish their data that are larger. So that's one example you can use. You can always, use any public information that's available. I know the agencies put together data and then they put it on their webpage. So that data is available. All of that comes from the call report. So I don't think using call report data is an issue. The standard is intentionally flexible here. So whatever data you're using can be internal, external, hybrid. It's really just trying to make sure you capture what's relevant for your institution on measuring your allowance.
Okay. So for the loan pools, then they could potentially utilize call report data or maybe go dig a little bit deeper in based on the risk, potentially.
Yep. Yeah.
Okay. Okay, let's see. I think we're going to have to probably end it right there. So I want to thank you guys for taking the time. Again, I want to reach out to everyone on the call today. If you have specific questions reach out to these guys. They are available. They will be doing outreach again, as Jay mentioned early on. They'll continue to do that. As we get that information, we'll push that out to everyone so that if you have an opportunity, maybe one of these days, Jay, you guys will be on the road again, who knows? But definitely, you know, over these next few years, we want to keep you guys in the forefront with CECL adoption. So, all right, so we're going to end it there today. Just want to have a couple of reminders going forward. Again, thank you to all of our speakers today for all that you've done. Thanks for everyone for attending. Just a reminder that we'll wrap up our last 2 days, day 4 and day 5. There on the screen on November 4th and November 5th. We will hear from Senator Kevin Cramer, who serves on the Senate Banking Committee, and Casey Matthews, Executive Vice President and Chief Investment Officer at UMB Bank in Kansas City, on November 4th. The day after the elections on November 3rd, so it should be good to hear from Senator Cramer as to what he has to say about the future based on the elections, and also the potential economic impact that Casey Matthews would talk about from the economy based on where the election has had, what's gone on with the election. And on November 5th, I'm honored to be moderating the regulatory panel. We'll have James LaPierre from the FDIC. James doesn't hold back, so look forward to that. Christian Gaffney from the Federal Reserve and Ben Rudolph from the OCC. And then we'll also have additional industry updates for you on November 5th. So please make sure that you join us on those. Go out to our website, and there it is on the screen for the bank seminar. Have people within your bank. I think the Senator Cramer, you know, I want to get our numbers way up. He's really taking time out of his busy schedule to come and speak to us, and I don't think he's going to hold back. So it should be a fun seminar there on the 4th, and some good economic information from Casey Matthews. So thank you to everyone for being here today. Have a good rest of your day, and we'll see you on November 4th.